Markets around the world are slowly but surely moving higher. 7 weeks in a row of gains, another green day today, and it's hard to see any bears in the market. Should we get cautious or should we get bullish? Today, we bring you the stats on what exactly new all-time highs means. 3 months on, 6 months on, and 12 months on. And we also need to talk about smart money. What is smart money doing? History tells us that smart money is normally ahead of the curve. Are they buying? Are they selling? Or are they rotating? Because as markets around the world hit new all-time highs, smart money will be doing something different. So for those who have sat out on the sidelines, it does seem pretty hard to get involved. So we're going to show you today where value can be found. So join us today as we discuss everything in the financial markets and how to navigate the post-OPEX pre-Christmas week of trading. Hello everybody, my name is Chase, and welcome to the daily recap show where we talk about stocks and the financial markets. If you like this video, please subscribe, hit the notification bell. Let's get into it. Another day of fantastic breadth. Apple sat this rally out on import ban news. Adobe up 2% that the acquisition is not going through. But other than that, the big players, communication services, Nvidia, Meta, Costco, another 3%. The big players all gained. Defensives too, very weird price action, but it was just great breadth across the board. And looking at breadth, this is what you want to see in a bull market. You want to see names like industrials, technology, comm services, cyclicals, produce great breadth, and stuff like defensives, healthcare sitting where they are right now. This is risk on. And looking at the weekend sentiment survey, you guys are bearish for this week. The next 100 points in the S&P 500, 57% of you said down, 43% of you said up. And we finally have more than 100 votes, guys. And it looks like strength will continue into the end of the year for the bulls. This is the S&P 500 returns for the last 10 sessions of December. On average, we see a return of 1.17%, but we can break it down further. The presidential cycle year 3, normally 1.59% return. If we actually have a look when the first 10 days are positive, 0.82% return, and when the first 10 days are negative, 2.51% return. Normally the last 10 days are super bullish, even if we have a negative December or a positive December. More gains leads to more gains. Now the Santa Claus rally period, which is the last 5 days of December plus the first 2 days of January, average return 1.66% since 1928, 95 observations, statistically significant. And presidential cycle year 3 into year 4, 0.9% average return to only 23 observations though. This is far more significant. Looking at the majors today, it was all large caps, mostly large caps. The S&P 500, the Nasdaq put up the best days. Mid caps and IWM didn't do so well, but they did have a massive bid up early on in the day, and that was mostly on the back of metals and mining, a falling dollar, which bodes really well for commodities, as well as yields coming down significantly, and yields were bid up in the middle of the session. So that's why they fell towards the end of the day. So there was a lot of headwinds and tailwinds for small caps and mid caps, where the large caps kind of just prevail. And here are the sectors. Like I said, XME, metals, as well as energy got bid up at the start of the session, and then it got sold off towards the end of the session. But it was a lot of risk on sectors that were doing really well. XLK, XLY discretionary, XLC, software as well. Risk on sectors were bid up this Monday. And the reason why metals were bid up so early in the session was because US Steel is being bought by a Japanese rival for $14 billion. This sent the stock flying. They're being bought for $55 a share. It's the reason why metals were flying, as well as a weaker dollar over the weekend. And we want to keep a keen eye on mining and metal stocks over the next week. But what else should you be watching? Well, today is the final week of earnings for Q3 2023. It's been a fairly good earnings, not as big as anything where we had massive earnings beats, but good in the sense that we finally broke out of the earnings recession. 3.2% year over year earnings. In the last week of earnings, FedEx to report, Accenture, Nike as well, Micron, BlackBerry, and I might have a look at Nike's earnings on Thursday. Now, Q3 earnings are officially over, guys. 3.2% year-over-year growth. This is what we can expect next quarter, and it's much of the same, 3.1% right there for the S&P 500. The best performing sectors should be financials. We're going to talk about XLF a little later, as well as tech. The worst performing sectors is definitely going to be materials and energy. If you remove these two sectors from the S&P 500 earnings, you're looking at about 5% earnings for the quarter, which is very, very good. And this is why we're seeing smart money move money into the market. They want to take advantage of sectors that have underperformed, while dumb money and retail have been the major driver of flows in this rally. And I think we're going to see smart money chasing in the next 2 to 3 weeks. And in my opinion, I actually think dumb money has outperformed smart money over the last 6 to 7 weeks. And I'm going to show you why a little later. So dumb money is actually buying. Smart money is probably going to start buying. Does that mean stocks are worth buying? Well, they're not cheap, they're not expensive, they're fairly valued. I think a 20 PE is fair value. Some people will say it's super expensive, but the S&P 500 forward PE ratio is 20.2, and here's why I think it's fair value. The reason being is that with the 10-year tips below 2%, this represents about a 3% equity premium over tips, which is similar to the historical performance of stocks versus bonds over the last 200 years. And that's why I think the S&P 500 at a 20 PE is fair value. And I think the market also thinks that too, because we've had 7 weeks of positive gains and it looks like the streak is going to continue. Have a look right here. S&P 500 positive win streaks. So we've had 7 positive win streaks. What are the returns we can expect 1 week later? In the S&P 500, 0.49%. 1 month later, nearly 2%, 16 wins, 4 losses. And have a look at the 12-month returns, nearly 12%, 17 wins, 3 losses. But the Nasdaq is now at new all-time highs. What can we expect for the Nasdaq? And like I've always said, momentum feeds onto momentum. The Nasdaq during the pre-Christmas week with a trailing year of 10% or more, we normally see 1.38% returns, 24 wins, 5 losses, and we can especially expect further bullish action towards the middle of the week. Now, the Nasdaq and the S&P 500 are both fairly valued. Where can we find good value though? And I think value stocks are good value. According to the Gotham yield, as of today, 10.35% yield, extremely cheap, and this equates to a forward 2-year return of 32.32%. This is a very interesting indicator, and I think one section of value you can look at is just small caps as a whole. Small caps are starting to break out against the S&P 500, and on a forward PE basis, trading at 13.4 as well as 1.43 price to sales and 14.3 enterprise value to free cash flow. It's looking extremely cheap. And normally after the first Fed rate cut, they tend to outperform large caps quite significantly, upward of 4%, upward of 2%. And we do know that if we avoid a recession and Fed does cut rates, large caps absolutely soar, which means large caps do well, small caps do better. The reason why I am bullish on small caps is because financial conditions are easing. We can see the financial conditions index is pretty much plummeting, and that's because 130 basis points worth of rate cuts is priced in by the Fed fund rate futures. And if these are to materialize, financial conditions will continue to fall. And I think this is a really good thing, and it's really good for companies, small caps, and even just individual Americans. And we are seeing central banks around the world ease. They are cutting rates because I think a lot of them know they over tighten, and they're seeing a lot of the deflation risk that's coming into the market. And a lot of this financial easing is being seen in sectors such as technology and financials. This is the percentage of issuers reporting cost headwinds, and reports of cost headwinds have decreased across all major categories, but particularly technology, financials down 23 to 34%, as well as retail down 35%. These are risk on sectors, and sectors that are poised to perform well next quarter and next year. And this is why we're seeing earnings estimates like 11.8% in the S&P 500. Have a look at healthcare. Have a look at information technology, 16.8%. Have a look at discretionary, essentially retail, 12.6% increase. And looking at earnings revisions, it's still above its historical trend. And this is why the big players are changing their forecasts. Look at what Fundstrat is predicting, 5,200 at the end of 2024. JP Morgan 4,200. Goldman Sachs was predicting 4,700, and they just changed their tune to 5,100. They predict a price target year end of 5,100, and this is how they see it: 5% earnings growth at a 19.9% PE. The market is expecting 11% at a 19.2% PE. So in both cases, multiple contraction, and Goldman Sachs overweight infotech, healthcare, and energy. And the reason for this is they say a deceleration in inflation and Fed easing will keep real yields low and support the PE multiple greater than 19. We'll see how many more of these banks change their tune into 2024. It's going to be very, very interesting. Now, I do believe this has to do with the strength of the economy. And despite all the recession talks and everything we're seeing, at the end of the day, the two main indicators that matter, employment and personal income. Non-farm payrolls is at a high. Disposable income, personal income in the US is at a high. And this doesn't indicate recession. At least all the research I've been doing, especially this past weekend into recession, when non-farms are high and when personal income is high, it doesn't lead to a recession. Now, these can change any moment, literally at any point they can change, but until they do, the economy is strong. Now, Goldman Sachs is actually predicting personal disposable income to increase year over year. Now, we have seen an increase this year. You can see this red line. This is year over year change, and they are expecting a year over year change next year. And as long as we're above the zero line, it's actually an increase of about anywhere from 2 to 4% year over year next year. It's not all rainbows, guys. If you look at the data from 2 years ago, 18 months, 24 months ago to right now, unemployment is ever so slightly increasing, still well below the historical average right here. So we do have to keep our eyes on this. We do have to be vigilant. We do have to be unbiased and look at all the data evenly. Let's talk about seasonality. This is what we've done in 2023, and it looks like we still have a little bit more to go. We could continue this squeeze upward because of shorts. Now, look at the amount of cumulative short flow in US single stocks, 35%. And I think these are pretty big funds. They are heavily short. And if this goes down, we could see a massive short squeeze all the way to 4,800. And I think a lot of this is CTAs. What's also going to help us into year end is gamma. Now, I posted this on the weekend. At the time, the call gamma strike, the call gamma resistance strike was 4,700. And I said, after OPEX, if the GR repositions at 4,800, expect SPX to reach 4,808 by this date. If it stays at 4,700, expect choppy digestion in this range until the 27th of December. After that, downside fake out, new all-time highs. Here's the JEX map. We went from the 4,700 strike all the way to the 4,800. The call resistance is at 4,800 right here. Now, there's so much gamma between where spot price is right now and 4,800 strike. What this means is we're probably going to have a slow climb all the way up to the 4,800 level. And looking at the S&P 500 chart, what this is going to look like is something like this. Choppy action in this area, slowly making our way to 4,800 at the end of the year, because this is where call gamma resistance is positioned. If it had stayed at the 4,700 area, what I was expecting is choppiness like this, a downside fake out, and then up. But because the gamma strike has moved into 4,800, we're going to go higher. And at the 4,800 level, the new all-time high level, there's actually quite a bit of negative gamma, which means when we get to that level, dealers will have to chase into that level, and that could support the blow off top. And this is also something that I said on the weekend. I said the gamma, since the gamma resistance has repositioned at 4,800, expect upward price discovery as we slowly make our way to this level by this date, the 27th of December. In the meantime, if the VIX bids up above the 13 level as we trade our way to 4,800, we can then look for a blow off top brought to you by a VIX crush. And that's what we saw today. We saw stocks up, VIX up, and we're going to continue to see this towards the end of the year. And the VIX is going to crush, stocks are going to have a blow off top, and that's how we get our new all-time highs. Now, looking at a bunch of other charts, Russell 2000 inside this area right here, what the Russell really needs to do is break above here, use it as support, continue higher. We are seeing positive breadth divergences, very, very bullish. What regional banks need to do, use this 104 level as support and continue higher to 127. It looks like the breakout we're seeing in 2020. Looking at the XLF financials, I want to speak about this one a lot. Financials have broken above the 3710 level. What they need to do now is consolidate here and move all the way up higher. And have a look right here. Corporate insider buying in the XLF. We saw a ton of buying right here. And in every other instance when this has happened, we saw 12-month returns of 17.81%, 88% of the time. Now, having a look at the equal weight, very similar to what the XLF is doing. There was a huge line right here. It's breaking above. It just needs to consolidate and move higher. Price target 75.60. Now, we also have some dark pool activity here for the equal weight. Huge trades coming in. This could be these could be buys, these could be sells. Nonetheless, just wanted you to know that there's very big volume coming coming into the equal weight at the end of the year. And based on the macro picture, price targets and everything, I would expect these to be some buys. Expect huge amounts of support at the 150 level. There's a ton of volume right here. So we could see a bounce at that level or just continuation to the upside because we are in a very seasonally bullish week. Now looking at the XLI industrials, very similar. It's broken above this trend line. It needs to consolidate, move higher. 137 is the target. And looking at the TLT is slowly making its way to the 109 level. There's going to be strong resistance right here, but what it needs to do is push up all the way to 109, break above, consolidate, and move up. And you can definitely tell a theme here in all of these indexes. They're breaking above key resistance zones and looking at higher price discovery for 2024. And that's normally a risk on signal for those. And looking at TLT, I want to show you something very interesting here. Big trades came in today. Whenever we've seen huge trades come in at the same time, what do we see? Slight pullback, rally, slight pullback, rally. What are we seeing right now? Slight pullback and then a rally. And I do have an end of year price target for the TLT 2024 of 131. Very ambitious, but that's where I think bonds are going. Now, looking at data ahead, we have the big one is just PCE. There's not much data. We do have durable goods as well, but in new home sales, a lot of people are going to be keeping an eye on that. Not much data in the grand scheme of things. But guys, if you've made it up until here, thank you so much. Please subscribe, like the video, leave a comment, hit the notification bell. Cheers.